This war did not start this week. U.S. Central Command says Operation Epic Fury began on February 28th, and this is its own strike footage from March 1st. The bombs are real. The damage is real. The human cost is real. The International Maritime Organization's current incident table counts 56 maritime incidents and 18 seafarer deaths as of July 15. 2 more ships were damaged off Oman on Tuesday. 1 was abandoned. People were killed and injured. This is not headline theater. This is a live shipping risk. But the market does not price every explosion the same. It prices the bottleneck. The Strait of Hormuz is the pressure point between Gulf exports and open water. When trust in that route falls, the first bill shows up in the barrel. Brent is holding around 85. VIX is around 16. The 10-year yield is near 4.57. Here is my read. The market is charging the toll for the Strait, not pricing the end of the world. Headlines are sirens. Portfolios move through pressure chains. The first mistake is acting like the market just discovered the war. It did not. The conflict has been running for months. Airstrikes, drones, naval operations, sanctions, and shipping disruptions were already part of the tape. Markets had time to build a framework for all of it. What changed this week was another burst of danger around commercial shipping. That matters because a bomb in one location and a damaged ship beside a choke point do not carry the same market transmission. One is a military event. The other can threaten freight, insurance, delivery timing, and the reliability of oil flows. On July 14th, ALBA Hayat and Mombasa B were damaged 13 nautical miles off Oman. 2 seafarers died on ALBA Hayat. 3 were injured. Mombasa B was abandoned after 11 injuries. The IMO table gives the names, locations, and damage. It does not need dramatic narration from me. The same day, U.S. Treasury announced sanctions covering more than 50 people, companies, and vessels tied by Treasury to Iranian oil exports and shipping. New physical risk, new legal friction, same choke point. That is the setup. Not war equals stocks down. The question is, which pressure gauge moves first? Which one follows, and which one refuses? Look at the map. Iran sits on the north side of the strait, Oman sits on the south, Gulf ports and export infrastructure sit behind a narrow exit into the Gulf of Oman. The geography does not predict an attack. It explains why a shipping incident in this corridor can reach a portfolio faster than an incident far from a trade route. The IMO Council is focused on the established traffic separation scheme and a sustainable return to unhindered navigation. In trader language, the route still exists, but the cost of trusting it has gone up. Markets can price that loss of trust before a formal closure ever appears. This is where our Godseye view earns the cut, not as a spinning globe. As a pressure map, the route, the surrounding coast, and the energy infrastructure belong in one frame because they explain the mechanism. If the map does not teach the trade, it does not make the edit. I am not going to paint fake ship traffic onto the water. IAS coverage can be incomplete, and the feed has no guaranteed Gulf receiver coverage. An empty patch on a screen does not mean an empty sea. The map owns geography. The incident table owns the event record. The charts own the market reaction. Start with Brent on the daily chart. It closed July 10th at 75.22. It jumped to 83.31 on Monday, then traded up to 87.55 on Tuesday before closing at 85.15. That is a real repricing, but the close below the high tells you buyers did not have unlimited control. Today, Brent opened at 85.21 and traded between 84.51 and 86.55 before this recording cutoff. The market is still holding most of the move. It is also still trapped inside Tuesday's range. That is tension, not resolution. The lower decision area is 83 to 84. If buyers defend that zone, the war premium stays in the barrel. The upper decision area is 87.55 to 88. A completed daily close above that range would tell me the market is demanding another layer of compensation for the Strait. If Brent loses 83 after a real improvement in navigation, the premium is probably unwinding. If Brent loses 83 with no improvement in shipping, I look for another driver before I declare the story dead. Oil is the first gauge in this cockpit. It is not the whole cockpit. Now look at XLE, the energy sector fund. It closed July 10th at 55.08, jumped to 56.74 on Monday, and finished Tuesday at 56.95. Early today, it traded near 56.73. Producers received the first wave of the oil premium, but the follow-through is already less explosive than the first jump. The support line is Tuesday's low at 56.29. The immediate ceiling is 57.22. If Brent pushes through 88 and XLE clears 57.22 with it, the producer channel is working. The commodity and the companies are moving together. If Brent rallies while XLE slips under 56.29, I stopped calling it a clean energy trade. That split would tell me the barrel is carrying a contract-specific risk premium, while equity buyers are becoming selective. The trade can still work, but the message is weaker. This is the channel's point of view. Do not marry the headline. Make the pressure travel. Event to crude. Crude to producers. Producers to inflation-sensitive assets. The farther the move travels, the bigger the portfolio regime. When the chain breaks, that break is the information. Now test the broad market. The S&P 500 fell to 75.06 on Monday, then recovered to 75.43 on Tuesday. It took a hit. It did not break into disorder. That matters because a true risk-off regime should not need excuses from the index. VIX makes the split even clearer. It closed Monday at 1650 after trading as high as 1756. Early today, it was near 1616. If fear were spreading across the whole market, volatility should be expanding with oil. Instead, it is sitting near the lower end of the recent range. The 10-year yield is near 4.57, below Tuesday's 4.587 close and below Monday's 4.624 close. That does not mean inflation risk disappeared. It means the rates market is not buying a fresh breakout yet. Oil is shouting, bonds are listening, but they are not running. If this were broad panic, the S&P, VIX, and the 10-year would be yelling with the barrel. They are not. So, I am not using the word crisis for the portfolio regime. The war is a crisis for people in it. The market regime, for now, is selective repricing. This morning's producer price index adds a useful twist. Final demand prices fell 0.3% in June. Goods prices fell 1.4%. Energy prices fell 6.4%. Services rose 0.2%. The headline says producer inflation cooled before the latest jump in oil. But June PPI is the rearview mirror. Today's Brent chart is the windshield. The report captures the old energy decline. The market is now deciding whether July's war premium reverses part of that relief. Mixing those two time periods is how a clean number turns into a bad trade. The PPI measure that strips out food, energy, and trade services rose 0.1% in June and 5.1% over the year. That is not a victory lap. It is also not a fresh monthly acceleration. The inflation story is softer at the margin, but still sticky underneath. The 10-year near 4.57 says race traders are not treating the oil move as a new inflation breakout yet. If Brent closes above 88 and the 10-year pushes through 4.64, that changes. Until then, the better read is backward-looking inflation relief meeting forward. Here's the base case. Brent holds between roughly 83 and 88. XLE stays above 56.29. VIX stays below 17.56. That is a bottleneck premium with limited contagion. Energy gets paid. The broad market keeps trading its own earnings and growth story. Escalation needs more than another frightening clip. I want a new shipping incident or policy shock. A completed Brent close above 87.55 to 88, and at least 1 second gauge. XLE above 57.22 says producers agree. VIX above 17.56 says fear is spreading. If oil spikes but XLE and VIX refuse, I treat the move as narrow until the chain proves otherwise. That is not complacency. It is position discipline. One market can be right about one risk without every asset joining the same trade. An unwind also needs two pieces. I want an official improvement in navigation, then Brent below 83 to 84 and XLE below 56.29. A diplomatic headline without a price break is only a headline. A price break without a route improvement may belong to demand, inventories, or another catalyst. This is not a prediction, it is a decision tree. The event tells you where to look, Brent tells you whether the market cares. XLE, VIX, and the 10-year tell you how far the pressure traveled. That is how we keep a war headline from hijacking an entire portfolio. The war is real. The human cost is real. The market message is selective. Brent is pricing the Strait. Energy stocks are carrying part of the premium. The S&P, VIX, and the 10-year are not pricing synchronized panic. So keep 83 to 84 and 87.55 to 88 on Brent. Keep 56.29 and 57.22 on XLE. Keep 17.56 on VIX. Those are the gauges. The headline is only the alarm. Do not trade the siren. Trade the pressure chain. If you want daily market news with a usable map instead of recycled fear, subscribe and come back tomorrow. News and education only. Manage risk like the market can change its mind, because it can.